TFNN. Headline News Update. Here's Tom O'Brien.
Hi, folks. This is Basil Chapman sitting in for Tom O'Brien. Tom is on his way back from a business trip, and I'm sitting in for him. So I'll also be doing the show that he does right now at 10 o'clock a.m., and I will do my usual show at 11 o'clock called the Tiger Technicians Hour. So let's go straight to the numbers. The Dow is up 30 at this particular point. It's actually up 31 at 17,997. Very sharp pullback yesterday. I'll discuss the details in a moment. Let's just get the numbers. The S&P is up 3 at 21.11. The comp index is up 9 at 51.32. You've got the GLD down a little bit, so that gold is at this particular point trading just about unchanged at 11.73. Silver's down a fraction at 15.79. High-grade copper is stuck in that 2.6 area, not acting all that well. But most importantly, the dollar is just holding. Let me show you the chart right now of the dollar, then we'll get to the charts as I move on. So the dollar hit that trend line, this dashed trend line resistance, but it's acting very well. And if the dollar is able by tomorrow afternoon to be up in the 95.70 area, it's at 95.18 right now, that'll start leg C in the Chapman wave methodology. And in the Chapman wave methodology, peak C's usually go to D's unless you get the arch formation. And so far, because of the euro, EUR, USD, the currency pair has got a very sharp pullback from a peak D, and peak D is the fourth highest peak you get in the Chapman wave. We've got to be careful. You can see the euro twice now has had a very sharp decline from that fourth highest peak. So at 1.118, this is very important because if the dollar rallies, you will see the euro quickly go under 1.11. Does that, it suggests that the pattern we're looking at in the weekly chart with these arch formations that make a lowercase h, which turns into a lowercase m, is going to continue, and it's just stuck in a trading band while the euro dollar continues to want to test lower levels and the dollar itself tries to test higher levels. Let's look at the bonds. And at this particular point, you've got the continuous contract down 5/30 seconds at 149. There's that arch formation. But what's really interesting is in the weekly chart, you've got a pattern that's called a declining wedge formation. And that says from this wedge formation, you should have a pop to the upside. And that pop to the upside might coincide with market weakness as money filters out from the equities into the so-called safety of bonds. So we're going to be watching this real closely. I'll give you the TLT because most people look at the TLT. 114.81 is the most important weekly 200-period exponential moving average support. Got to watch that very closely because the technicals are still very weak. So the thesis that I have is that if the market starts to pull back, if the Dow starts to break today underneath 17,000, or today or tomorrow, underneath 17,800, we'll have to see, and so into the 17,800s, and the S&P pulls back into the 2,099 area, then we're going to have to watch to see whether money does go back into bonds. So this is a very critical week, and I'll be going through this in much greater detail in the next 45 minutes in Tom's show. And that's going to go into detail as to the specificity on the very short term, as well as what I'm looking at in the intermediate term, because I do believe we had signals yesterday that are suggesting that we could be starting some kind of a decline, and let's call it a consolidation. And that consolidation has to affect the IBB, that's the very important NASDAQ biotech sector. And also we want to see how the VIX, the VIX, and I'll talk about that in this next hour. The VIX is rallying. It's at 1338. Can it hold the rally into Friday for a weekly positive close? We'll see about that. So thank you for being here. I appreciate it. Tom will probably be back tomorrow for this particular segment. And I will be staying on, and then I will be doing my usual show, the Tiger Technicians Hour, 11 o'clock till noon Eastern Time. And with that said, we're looking also at the way the rally did start off okay and then started to pull back. That is the sign of a weak market. So we've been watching this very closely. Thank you.
If you're like me, you're always looking for ways to diversify your financial portfolio. Everbank's innovative market-safe CD can help you diversify while protecting your principal deposit. In fact, Everbank unveiled a new 5-year market-safe power metal CD, which combines the power of gold, silver, and copper. Metal prices are currently low, so this CD could really deliver. Consider the facts. You get exposure to 3 valuable metals in one index CD and have the potential to earn up to 45% capped upside payment at maturity if the metals increase in value across annual pricing dates. And should they decrease? No worries. There's zero risk to your principal here, as you still get 100% of it back. Keep in mind, returns are based on CD performance. No annual percentage yield or periodic rate of interest is paid on the CD. Intrigued yet? The July 9th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is a member FDIC.